If you look around, there are so many ways to make a difference. At Capella University, our FlexPath format gives you a different way to earn your degree. Take courses at your speed. Move on whenever you're ready. Education should fit your life. Learn more at capella.edu.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Well, hello and welcome, everyone. Get on inside. You've made it to the China shop. We're back with another exciting interview episode. I'm Shopkeeper Dan. With me, as always, is Kyle, creator of financialineptitude.com. How are you doing today, Kyle?
Doing good. I think people might be getting sick of me saying I'm excited about today's guest, but man, today I am excited about today's guest.
Yes.
It's the first time we've had somebody who is an AI expert, and I think we've been wanting to get one on the show for the better part of a year now.
Oh, yeah. Well, yeah. AI is the forefront of technology. And we are so super stoked to have Stephen Mathai-Davis from Q.ai, a Forbes affiliated company. How are you doing today, Stephen?
Hey, Dan, great to be on the show, and no pressure at all, guys.
For us or you?
The AI already told him it's going to be a good show.
Right. So how'd you get into AI in general then? Is that something you went to school for, or you just found an interest in it through other work?
Yeah, it's funny, right? So I started off my career in institutional asset management, and there's been this ineluctable shift towards predictive analytics and smarter investing. Mm-hmm. So I was naturally gravitating to it. I started my career more in fundamental analysis and then found myself rapidly moving towards AI and other forms of advanced quantitative investing modeling. So that when I started to go get some of my advanced training, I had a real focus on behavioral finance and the application of AI to behavioral finance and investing. Big words for saying, application of AI to creating investment strategy.
I'm surprised that the institutional firm you're working with wasn't interested in what you were doing.
I had a lot of firms that were interested in it. And at one point, I was running my own hedge fund that was using many of the techniques that we're using at Q.ai to invest in emerging markets. But the reality was at that point, we were thinking about where was the next leg for us, an opportunity to really change things. And that's when we launched my most recent startup that was sold to Forbes in November of 2019, Quantimize, which was bringing AI-powered and factor research to the average individual investor.
Quantimize? I'm not familiar with that. What was that doing?
It was a research site.
Oh, okay.
Building recommendations based on using AI and other factor research-based models. Well, we had a lot of success there, but it was a content-based company, and we sold it, and I was trying to figure out what I wanted to do next, and that's when the Forbes team approached me about creating a new type of wealth tech app.
That's exciting. I was looking through the website for Q.ai, and it's not Qi like I was initially confusing in my head, the British television show where you learn interesting factoids.
Yeah.
Love that.
One of the things I was really surprised to see is that you don't charge any fees. So I was wondering how you, what the actual business model is then, if that's the case.
Yeah, long term. So we're an advisor, right?
Mm-hmm.
So we're not a broker dealer. We're not making money off people's trading flow. Longer term, we think we're going to be monetizing a lot more on the risk management side of things. Mm-hmm. So we're going to let people trade on Q.ai using our investing strategies, which we package as investment kits. Mm-hmm. But we've put together some really advanced hedging solutions and strategies that we think we'll be able to monetize longer term with. Talking about Q.ai for a moment and forgetting about just the application of AI. Mm-hmm. Our mission is to bring institutional grade investing to the average individual investor through a one-tap investing model. So any of your listeners check out the app. It's pretty simple and easy, intuitive to invest in really advanced types of strategies that you only find at elite hedge funds and some of the elite investment banks. The mission really is to democratize wealth creation. Mm-hmm. And we're not out to democratize finance. I'm not even sure what that means when people throw that around. Yeah. As somebody who's grown up in modern finance, as well as a kid, since my entire family is in the business.
Is that a slight at Robinhood?
I don't think it's slight at anybody. I think it's more... What can I say? It's, that's the wittiness coming out and saying, well, what does that even mean?
Right.
That was one of the jokes I had with our team as we were trying to come up with our mission. Really, our mission is really to democratize wealth creation. Mm-hmm. And that's a laudable goal. It's an audacious goal, but it's one you can work towards.
Right.
That's actually tangible. And that's really what we're doing with Q.ai. And we're bringing institutional grade investing through the power of AI, if that makes sense.
So what is the actual AI doing then?
Well, there's a lot of AI occurring. So let's start at the investment kit perspective. Our investment kits are powered by our AI strategies. The AI in this case is determining what to own and how much to own of something in a specific kit. So there are two layers of AI occurring. One, what securities to buy, and then how much of each security that we want to buy, how much do you own of it?
Right.
Then there's another AI layer, if you choose to use it, which is our AI-powered portfolios. That's really just doing asset allocation between different kits.
Interesting.
And then on top of it all is the AI that's driving our hedging strategies.
Now, the actual AI that you're referring to, is that like an actual like learning AI, or is that more like algorithmic?
No, it's primarily deep learning.
Yeah, okay.
So we've been using quite a bit of deep learning, and when you get into deep learning, that's just a concept that's thrown around ubiquitously. But we're using different forms of it. At one point, we've got an ensemble. With some of our strategies, we have an ensemble approach. We're using multiple types of deep learning algorithms. I like to call it the wisdom of the algorithms to figure out which is the best stocks to buy.
When it comes to AI, I've heard some fights between people over whether or not algorithms are considered AI. I'm curious what your take on that is. Is that a way to get in a fight with somebody who's like really into deep learning?
That's interesting, right?
Because it seems like there's a bit of a fight on like some of the YouTube videos I was watching on just different AI.
I try to avoid theoretical arguments because I think that's getting into like traditional machine learning and more advanced forms of AI, like deep learning or reinforcement learning. So I try to avoid those conversations. I wouldn't say that we have algorithms, and if we were going to get technical, it's really deep learning ensembles that are actually focusing on what types of securities to buy and what are the factors best driving. And
deep learning is where the actual AI itself learns from its experiences or from the data you put into it, correct?
That's correct.
How does that work? Like, how do you write that? Like, that just blows my mind.
Explain it to me like I'm a 5-year-old.
Well, here's how I would say it, guys.
Okay.
Take a look at what type of factors that drive price returns and what drives market returns. So we're looking at basic regressions. So we're looking at thousands of different types of factors, because garbage in, garbage out, by the way. That's really what's important with AI.
I've learned that.
So once we figure out certain subset of factors that make sense, we feed that into a deep learning structure where, depending on what the model itself is, like I happen to be biased to recurrent neural nets, without getting too much into the weeds here, that have a short-term memory bias, and look to see what the models themselves are as you tweak it, what the predictions are going to be for a different security. And I'm trying not to get too much into the weeds, because I know, Kyle, you were saying stay high level. You start to tweak it in terms of how the data is actually normalized, how the data is fed into the models. Begin to tweak the model in terms of how the percent changes are actually calculated. And that becomes more art than science. I mean, that's actually the core takeaway from that.
I never said high level. I think Dan said that. I'd be more than happy to go dive into the weeds. But that might not be very good radio.
I'm interested in how is there an AI level on QAI or time frame? Is this all for like I'm investing for my retirement, or can I throw some money in there and be like, hey, day trade this?
Yeah, that's interesting. The answer to that question is neither. Right now, at least the way the product's been created, it's really geared towards the best possible return, irrespective of timeline. We don't do intraday trading because that introduces a lot of noise. So we tend to rebalance on a weekly basis. We did a lot of research to figure out what made the most sense. And based on all the data that we pull in, and by the way, we're pulling in a ton of alternative data, we tend to restructure or rebalance portfolios on a weekly basis. That makes us very unique, right? Because most of the other fintech apps out there, they're not adjusting at all to real-time market moves, and you'll be lucky if they rebalance on a quarterly basis.
Why is that, do you think? Is that just because that's just more time-consuming? Or
No, it's just old school wealth management, right? If you look at FinTech 1.0, which were the first generation of the robo-advisors, they were just taking traditional wealth management models and putting a digital wrapper on it. We are attempting to build a 21st century company that's natively digital and holistic towards the online environment for millennial and Gen Z investors. Like, the joke for us is that we're building the next digital BlackRock.
Oh,
That's what we're building.
That doesn't sound like a joke to me.
It's not much of a joke.
That sounds like I want to see your company publicly traded so I could buy some shares.
Yeah. Put us on the short list for that.
Right.
Yeah, well, think about it for a moment, guys. If you look at the mutual fund industry today, 3 to 4 firms control over 75% of assets.
Really?
Look, and it's a $25 trillion business. The ETF business, it's $5 trillion plus. It's growing 20% per annum. About 4 to 5 firms control over 90% of assets. There's no product differentiation at all.
Right.
When you hear money managers talk about investing, they refer to it as an asset gathering business because you really get no upside for being innovative.
Huh.
Now, think about what you're getting as the average retail investor. You're not getting anything. I mean, what the hell? Why am I being marketed 10 different large cap US equity mutual funds or strategies?
Yeah, what's the difference?
How many large cap ETFs are there? Large cap US stocks ETFs?
There's so many.
What's the difference? I mean, I'm a CFA. Maybe I'll kind of BS around, sing a song and dance around tracking error, but it's all the same shit.
Uh-huh.
Yeah.
So for us, what we've been trying to do is create this new type of investing experience that really, in my opinion, will be bringing investing for the average individual investor into the 21st century. Just the same way that the wealthy experience investing when they give their money to Morgan Stanley, Goldman Sachs, or JP Morgan.
That's fantastic.
Oh man, yeah, this. I know it's not quite a great analogy, but I was thinking of like Fundrise, where you let like retail get involved in like some larger scale property applications or investment opportunities.
And there's going to be a ton of innovation here. We're not going to be the only kids around the block trying to do this.
Right.
That we see the market opportunity here.
Is there anybody out there trying to do this too?
I think there's some competitors who are trying to pivot to the space. I think our advantage at the moment is that we started from the beginning with a focus in this area.
Mm-hmm.
That's always a competitive advantage.
Oh, yeah.
Having a 2-year, 3-year head start helps too.
Yeah, and with our case, before we did anything, we spent the first year just doing market research. So before we even built a prototype, we interviewed 5,000 to 7,000 real customers on Instagram, Facebook, and Reddit.
Ah. And what was the information you gathered out of that?
Well, it was interesting, right? It definitely shook a few of my biases. One, nobody has any problems buying and selling securities. So they're totally fine with their BD experience.
Uh-huh.
So there's no innovation there. At least there's no innovation that would warrant, a startup focusing in that space. 2, nobody has any problems figuring out what to buy.
Mm-hmm.
The real feedback was, I don't know how much to buy of something. I don't know when to cut my losses or take my profits. And I don't know how to trade in what's becoming increasingly more volatile marketplace.
Mm-hmm.
I was like, wow, you're describing portfolio management.
That sounds very similar to our experience over the course of doing this show, like what we've been learning where the real struggles are. Like it's easy to find something and have an idea, but it's knowing when to get out or when to take that profit that really throws everybody off.
Yeah, sure.
Yeah, I think you'd be surprised at the fact that people really haven't tried to tackle this problem yet. And maybe we're just ahead of the curve a little bit because we were speaking to real customers.
Well, do they really want to? I mean, if you think about where the returns are coming from the people that know what they're doing, it's coming from the people who don't sell.
Yeah, if you're talking about startups, I just think it's portfolio management's hard. That's been part of our sales pitch.
Mm-hmm.
And when I was dealing with investors, it was, what's the opportunity? Portfolio management's hard. I think that's why you haven't seen a lot of innovation here. I do think, based on what I was chatting about earlier in the marketplace, and the fact that you're going to have roughly $60 trillion being transferred to millennial and Gen Z investors over the next decade to 2 decades, there's going to have to be some innovation.
Right. It's
not hyperbole to say the mutual fund industry as a whole, and we're throwing ETFs in here as well, really hasn't changed since the 90s.
Right.
Strategies, or at least funds, are still constructed, distributed, and sold the same way that they were in the 90s. And a lot of consumers don't realize that. They experience it, and that's why they don't like to necessarily buy mutual funds on the different platforms they're on, because they already intuitively know that they're not really getting a lot of options.
Mutual funds just seem like they've kind of fallen out of favor in general. Like I remember them being big when I was growing up, and like you hardly ever hear anybody talking about them now.
The industry itself is still growing 8 to 9% per annum. A $25 trillion industry.
Really?
Mm-hmm.
Oh, that's fascinating. Are you including ETFs with that, or just mutual funds separate?
That's just mutual funds.
Really?
ETFs is $5 trillion, and that's growing close to 20% per annum.
Dan, who is it we were just talking to who was warning about the ETF, all the assets being held by the ETFs is what he thinks is going to lead to the next crash?
Oh, yeah, because the ETFs don't vote well. That was Chiral Asseter.
Right, there's no governance. Yeah. Ah, that's right. Okay, that was what we just did.
Yeah, we just talked to him 2 days ago. Yeah.
So when you sign up with Q.ai, then you deposit some money, then you tell it, go ahead and invest this for me. Like, what are the typical things that it's investing in? Is it like just picking stocks based off of its analysis? Or are there like certain blue chips that you're trying to stick with? Or
No, the whole experience is a very bespoke, personalized experience. So when you invest in a different investment kit, you're investing into a theme. Some of the themes are longer term, some shorter term, and some are really specialized. So we've broken our investment kits down into what we call foundational kits, which are the core kits you should have in any portfolio. Maybe emerging tech, a value vault, global trends, an active indexer, which is just a way to play index returns by tilting index returns as well, just to outperform. Smarter beta, which is a way to play factor rotations. Then we have specialty kits, which are just specialized micro themes. We like, for example, guilty pleasures is one of them. That's one of my favorite ones. Where you buy
I love guilty pleasures.
You wouldn't be surprised. It's one of the most popular kits on our platform.
Is it really? Well, I guess it makes sense. Everybody wants it.
It's anonymous, so nobody knows.
Right.
Especially when the economy's not doing great, everybody reaches for those guilty pleasures.
Absolutely. And then we have our limited editions, which are short-term trades. So we have a pair trade going where we're long gasoline, short oil as a way to play the gas spike, while also hedging. We're going to be launching a new back-to-school trade in 2 to 3 weeks. And these are time trades. So it's really the basket trade experience that you have at the elite banks that we're bringing to the average investor.
What sort of returns are you seeing on these kits?
I want to be careful in terms of...
Right, you can't promise that, just generalized.
If you come to our website and look at our performance, you'll see that we're doing very, very well.
All right, let me load that up while Dan asks another question.
So basically, you're saying I put $10 in, and in 2 months I'm a millionaire. That's what I'm hearing.
Right.
Not sure I said that.
I did not say that. Do not hold me to that. Do you use Q.ai for your own wealth? Like, do you put money in and let the AI handle it yourself?
Yeah, well, more importantly, I have my wife do it as well, the real stakeholder.
Yeah. There you go. There you go.
I'm looking through the return page, and this is very impressive.
Yeah, that's why I'm being very careful talking about it. But if I could explain a little bit about the performance there. As I get a lot of questions, and we're going to start doing more webinars as we really come out of the gates and take the beta tag up over the next month or so. What's driving that is because we're doing weekly rebalancing, and the models themselves are learning every day, right? Because it's more data is being funneled into it.
Right.
We're able to quickly pivot with market shifts. And because we're using alternative data as well as options market data, futures markets data, we're able to make the models a little bit smarter in terms of predicting asset price moves, whether we're talking about ETFs and stocks. So if you interview a bunch of very elite hedge fund managers, they would talk about how you can infer about stock market moves based on what's going on in interest rate markets, futures markets, the options market. And all we've done is taken that experience and we've made it part of this customer experience for our users where they get to invest in strategies that are looking at the same things. And AI is just letting us do things with better probabilities. So I used to do this by hand for the portfolio managers I used to manage. When I say by hand, I mean in Excel.
Right.
But now, with the advancements in AI, you can remove me as the analyst and you have better probabilities.
Isn't that's amazing. What is the QI portfolio protection that I see on these charts? What does that mean?
Yeah, so that's a hedging strategy I was telling you about, where we're using AI to do actually some pretty cool things. So you have a lot of hedge funds that are what they call tail risk hedge funds, where they introduce strategies that frankly only perform well if there's a crash. So they'll underperform for 3, 4, 5 years, and then suddenly that one event happens and you get a big return.
And they look like geniuses.
Yeah, that's right. I've always looked at it as crazy. It's like, these guys have just lost money for 4 years.
Right.
And there's huge opportunity costs. So when we were building portfolio protection, we tried to figure out, well, how do we use AI to make us smarter? So we're using AI to predict whether or not we think the stock market's going to go up or down. The VIX is going to go up or down. Interest rates are going to go up and down. Oil is going to go up and down. And tech stocks in general are going to go up and down. And depending on what our conviction is and the sensitivity of your portfolio of kits to it, we might shift some of the allocation to cash. And if we're really high consensus that, for example, the market's going to drop, we'll short the market for you.
Right.
And we'll hedge out that market risk. So you're really getting this incredible experience that really only the elite high net worth individuals get at elite investment banks.
And Forbes isn't trying to shut you down?
If they're promoting you?
What is going on? This goes against everything I thought about the world.
Forbes, it's been pretty awesome to have us as the strategic backer, right? It's the natural convergence of financial media and financial technology.
I'm curious how that conversation went. Like, you said you started with another company that you started, a research company that they purchased from you. What went into that? Like, was that like just the best day of your life, or was that a nightmare of like 6 months of legal?
No, it was one of the best days of my life. It was incredible partnering with the Forbes team.
How did that conversation go?
Conversation was always very easy. It was, where do we think the market was going? Where did I think wealth tech was going to go? And it turned out they had similar perspectives. Mm-hmm. The next question was, can we build a product to take advantage of it? And our consensus was, well, let's go find out.
Yeah.
And then the rest is history, right? We went out, we met people, we were able to leverage the Forbes.com presence as a way to get in front of more people, use that as a brand recognition. And obviously, you guys can imagine it's going to be a core part of our acquisition strategy going forward.
Right. Oh, yeah, that's the dream.
So net for me, it made a lot of sense. And, if you take a step back and look at the wealth tech space, this has been done before, right? The Comcast Ventures backed Acorns. Uh-huh. So that when you see everything with CNBC, and I don't know if you guys sometimes see, if you watch CNBC at all, there's Acorns ads everywhere and presence everywhere. Uh-huh. It's because they're backed by Comcast and NBC Ventures.
Interesting.
No pressure on me, right? To deliver.
I know, right?
No pressure. I'm still trying to figure out how it can get monetized beyond using its own AI to invest. Like, if there's no fee for me to sign up, like, is it just you put some venture capital and let the AI build it?
No, over time we're going to look to monetize some of the risk management, like portfolio protection. We're going to create a hedge kit. So, for example, let's say you have a 401k with Vanguard, but you're very limited with what you can do in your 401k. Well, we can build a hedge kit for you in Q.ai that's going to use the same technology that we're using for portfolio protection, and we'll hedge your exposures in your 401k for what we call a micro subscription.
Interesting.
It's all part of the thesis that investing is moving towards, at least money management in general, is moving towards what we call the Netflixication of investing.
Does that mean you're also going to cancel everything after a season? Mm-hmm.
Mm-hmm. I'm not sure about that, but it's going to go from free to freemium.
Right. Netflix isn't on any of your stocks, is it?
It can sometimes show up in a few of them.
Actually, yeah, I guess would be a good short sometimes.
Well, it's definitely. It's certainly, it could show up in a few of the others. Like we have our short squeeze kit, which has been a play on overly shorted stocks. Uh-huh. I don't know what short interest is right now in Netflix, but it's very easy for that stock to show up there.
Right. I was looking at your, I guess it's on the Forbes site. Looks like a list of blogs that you guys have written. So you guys are also making content too? Yeah,
we're aggressively increasing our content presence on Forbes.com as well as on our Learn Center on tryq.ai, where we're pushing what we call investable and snackable investing content.
One of the ones that popped up to me was Revlon, because we were just talking about that a couple of weeks ago about them filing for bankruptcy and then watching it shoot up.
Oh, yeah.
What was the reason for that? I'd like to see you go into that, because we've seen that a couple times.
Yeah. Why?
Is that just because everyone who's been short of it waiting for the bankruptcy is now closing out their positions? Or
it's usually a short squeeze / you think there's going to be some value extracted from the restructuring. So I want to be careful. I'm no longer a fundamental analyst.
Okay.
So I want to be careful of any storytelling along with that. But I would say, usually, you buy on the rumors, sell on the news. Uh-huh. That certainly applies to situations like Revlon.
Is Wall Street Bets, is that part of the QA or the AI's inputs? Looking at the stuff that they're talking about on there?
Absolutely. We've been active in Wall Street Bets going back to my old startup, Quantimize, back in 2015.
Oh, really?
Yeah. Yeah, at one point we were great.
Wow, so you were an early adopter of monitoring social media.
Very much so, and very much an early adopter of monitoring chatter on Reddit.
Interesting.
Oh, I wish I had AI to do that for me, because there's a lot of inane chatter on Reddit.
Oh, God, there was a really good thread I saw in there talking about AI, like analyzing Reddit, and then it makes a decision to YOLO the entire portfolio on 0 data expiry. The SPY calls like 10 minutes into the close.
Yeah.
I don't think that really happened, but there is always some trepidation on like AI, just because it being new, that there may be some pitfalls in there. Are there any protections that you have in place to kind of prevent it from like going off the rails?
The best protection you can always put in place is have human oversight. Uh-huh. So we're always looking at the models week to week to make sure that we are in agreement with what the models are doing, not necessarily as a check, but really to make sure that it's not going off the reservation.
Right.
And it's led to very strong outcomes because it's caused us to go in and tweak what the models were doing.
Not only is the AI learning, but you guys are learning as well as the keepers of it.
In terms of how we're putting factors into it, what factors are actually creating more noise. That's really important. Garbage in, garbage out is really important when you think about the application of artificial intelligence to anything, but in particular to the stock market.
The market's always been a tough one for me. I always wondered if AI did have a future in this space just because it is so emotionally driven.
Well, markets tend to be non-stationary, right? Which means there are regime changes that occur at week to week, month to month.
Mm-hmm.
I've actually found that artificial intelligence or the application of predictive analytics is more effective than using human fundamental analysis to figure out how to build a portfolio.
Mm-hmm.
I'm not talking about, is the stock going to go up or down, how much a stock is going to go up, but using artificial intelligence to construct a portfolio system,
right?
Invest into, I think it definitely finds a lot of application.
Now, are there any concerns of a Q.ai becoming self-aware and maybe taking everybody's money and launching nukes?
I'm not sure, not at this point, about whether or not I'm building the next Skynet.
How do you answer that question? Because it's really hard not to ask it.
I try to avoid it because it leads to even more jokes.
All right, fair enough. Dan, what do you got?
I'd like to speak more on your experience as a black belt and competitive kickboxer, because that seems to be a theme with finance guys.
Oh, yeah?
Why is that? Yeah. We just talked to an MMA guy. We talked to another guy who was a kickboxer. Yeah.
Oh, no, like legit.
I thought it was unique because of that. Jeez.
In fact, one of the guys we talked to, he says he actively recruits people from the space.
I don't know if I'd make a habit of actively recruiting people from this space.
Yeah.
Mm-hmm.
I did it through most of my teens and 20s. It's definitely shaped the way I approach things, certainly.
Dan, are you trying to turn this into a MMA podcast?
No, I'm trying to set up Two Bulls in a China Shop sponsors the Financial Fight Fest, where we just get a bunch of finance guys fighting each other.
Some white collar MMA.
Right? Oh, fuck yeah, I'd watch that.
The Thriller in Vanilla.
I've got a 5-year-old son. It's like, the family sport he's already taken to boxing, and he's beginning to kickbox since he's combining punches and kicks.
Oh, nice.
and of course, you're such an easy target, right?
Usually he's running after my wife and my in-laws, so it works out for me until everyone starts yelling at me. I've got to stop it.
Let's take a trip back to your past. When you first started out, it looks like you worked for a couple different financial groups. You worked for Piper Sandler as a trader.
Yeah.
Same with Sunridge Capital. What was your role with those companies, and what does that mean? Like as a trader, what was your day to day?
My day to day, at least when I started off in investment banking, was as a market maker. Trading NASDAQ and NYSE stocks. This is kind of ancient times in the early 2000s.
Mm-hmm.
It was a great experience for me because this was when the transformation to electronic trading was occurring. So I got to see that or live it for a few years.
How big of a shock was that?
For me, it was the norm, right? So that's why I'm very comfortable with what we're doing with Q.ai. I'm not sure for people who were moving from analog to digital what the experience was for many of them, but certainly it's informed my career and it's given me tons of insights 15, 20 years later, as we're building this digital asset management company to understand settlement and clearing and how it relates to trading and portfolio management. So it was invaluable experience for me.
Mm-hmm. And then you went to PineBridge and worked as a research analyst.
Yeah, I was a research analyst and portfolio manager. It was first AIG Investments and then PineBridge.
Real quick, before we move on too far past it, I would like this. You're the first person we've talked to that's actually like, oh, yeah, I was a market maker. What is the big difference between somebody that's just running client orders and being a market maker? Like, how does that functionally different?
The market makers actually were required to be out with bids and asks that we were the guys building the market around a stock. So they say it's Amazon. I was required to be out at a price that I was going to buy Amazon stock at and sell Amazon stock at. And it was my job to help manage that risk around that for the trade desk.
So as the market maker, like when you look at like the options and like it's a asset that's not really traded too heavily, and you see like a really wide spread on the bid and ask, you're the guy who was coming up with the those wide spreads.
I was the guy putting in the wide spreads, and you better believe I kept it wide. Otherwise, the head of the trading desk would have my head. But the more interesting thing is for me, and this is going back to ancient times, is I got to see 2008, the crash around 2008, 2009 from both angles, right? When I was at Hedge, and then which was backed by Anchorage, which was that huge financials focused hedge fund. I was putting on all the shorts. Going into the subprime crisis, and then that's when I left for about a year to run my dojo and pursue a professional kickboxing career. And I like to joke when I was coming back, I was looking for a job where there would be a different level of pressure. So I said, I'm going to go work at AIG Investments, and literally joined AIG Investments a week before the bear insurance crash. So I have a unique perspective on all the characters you guys know about in 2008, 2009 on both sides of the trades.
Well, shit, we got to talk about that.
Yeah. Now, obviously, I cannot. I don't even know what I signed in my early mid-20s, but I'm sure it's tons of confidentiality agreements.
So how come nobody made a movie about you then? They made a movie about Michael Burry and his Big Short. It sounds like you were shorting around the same time.
I knew a lot of the guys that the Big Short that were mentioned in the Big Short, and a few of the guys who were not mentioned because they wanted privacy.
Interesting.
They just didn't want to be like, because Michael Burry now, he got that right. Like every time I see him on Twitter now, he's like, the market's going to crash.
Michael, he's a bit of a perma bear, right?
Yeah. Yes. Thank you.
But there are a couple of other guys who value their privacy, which I think is important.
And what are their names and address?
No.
Just names and emails.
Yeah. Right.
Yeah. There you go. Did they want to talk to us?
See, I didn't realize asking about your market maker days was such a loaded question. What are the parallels that you saw in the 2008, 2009 to what we're going through now?
Well, I don't think it's the same thing, right? It was leveraging the system. You could see that coming. Mm-hmm. I kind of reject the argument that people didn't see that coming, considering I was with a bunch of folks who saw it coming maybe a year and a half before it did. Right now, I think this is just more of a resetting of valuations, especially in tech. Because now, I'm in this fintech startup space, and I've even spent time talking with our team about it. Because people have asked about what this means. And my perspective was valuations just got totally disconnected in the venture market from economic value. Mm-hmm. It's just a resetting. Yeah. I'm actually not as bearish as other people about a recession. The economic data does not point towards a recession. It just points towards a deceleration in economic growth.
Really?
Yeah, if you look at aggregate demand, which is a measure of the U.S. economy's strength domestically, it's growing faster than real GDP. And we're talking in real terms, right, adjusting for inflation.
Right.
Yeah. So GDP is going to capture the impact of exports to emerging markets, Europe, et cetera. But we're focusing really just on aggregate demand. Aggregate demand is still very strong. And you're seeing that in the retail market.
Right. But what about with the Fed, reducing assets on their balance sheet? Like, isn't that like a major red flag? And you consider from 2008 to now, basically, we've been pumping trillions of dollars of liquidity into the markets, and then now that money's gone.
Unless you think the Fed is going to be completely derelict and tank the entire economy, they're going to be doing it in a very organized fashion and structured way. Mm-hmm. And listen, coming into the year, and we talked in November, December, I thought there was going to be a pullback. So we actually optimized it. We were talking about AI and the oversight there. I was working with our quant team to really focus on downside performance, maximizing concepts like the Sortino ratio, which is how do the strategies perform in down markets. Mm-hmm. Going into the beginning of the year, we were telling people to go into our precious metals kit, buy the inflation kit we were building, play the safe. Now, fast forward to now, the market is, at least from a PE perspective, kind of coming in line with normalized levels. Mm-hmm. Peg basis, which is how much we're paying for forward growth, it's at a discount. Is it time to sell the market anymore? I'm not sure about that. I'm not telling you to pour all your money into
right.
the S&P 500, but is the S&P 500 too overvalued? I don't know. You're better off putting your money into Q.ai.
Exactly.
There you go. It all comes back to Q.ai.
Yes, it does.
We spoke for a long time. We made fun of Tesla's valuation, price to earning.
It's just disconnected from economic value.
Yeah.
It still is.
Yeah. By the way, Tesla's a great company. I drive a Tesla.
Do you?
Yeah, I do. I'm a big fan of the company, but valuations disconnected from, at least valuations were disconnected from the economic value that was going to be generated over the next year to 2 years.
So what do you see for the next 6 months then going forward?
What do I think? The market's going to probably drift a little higher going through the summer months. Right now, we're putting together this back-to-school trade, which is looking at retail and tech companies that are going to do well as people go out shopping to send their kids back to school. It's a cyclical trade that happens every year. Don't ask me why this constantly happens. It's like the go-to trade of Wall Street in September after Labor Day. And I was looking at the growth numbers, and just incredible, the discounts to growth that all these major companies are trading at. I'm talking about Apple, Walmart, Target. I mean, just from a valuation perspective, they look fantastic. So looking into the second half of the year, I just think you're going to start to see a trend up. Every time the Republicans take the House back, typically you see a little bit of a bounce back in markets as well. So I probably expect that to happen. Also,
the markets Dan and I have talked about too, that seem to enjoy having a Democratic president and a Republican-controlled Congress.
That's usually the best combination.
And I think the reason for that is just because that means nothing's going to change.
And, when things do change, it's usually very bipartisan.
Right. So what does QAI think is going to happen over the next 6 months? That's the real question.
Well, QAI, remember, we're trading week to week, so we're not looking out 6 months.
Oh, okay. That's right. So you don't even have like a long-term thesis going on there. You're just actively analyzing what happens in any given week and then rebalancing.
We always look week to week. We try to look out 6 months, 3 months. It's not really predictive, right? There's just too many unknowns.
Do you plan on expanding that capacity in the future, or is this just the strategy that you found that performs the best?
Looking into the crystal ball, potentially. we had our product offerings. I would say, based on all the academic research I did previously, and then our experiences with QAI, the predictiveness, at least in terms of the application of artificial intelligence and other advanced quantitative models, it loses its predictiveness as you get further out than 1 month.
Sounds like the weather predictors too.
Yeah, right. That's what the joke is with when you hear the weather, it's really only a day out that's predictive.
Right.
No point paying attention.
Do you do anything with like emerging markets, or do you stick more with like U.S. equities?
Well, we'll trade emerging markets stocks and ETFs that trade in the U.S. So we trade a ton of ADRs, and then we do have some of our kits that own emerging market ETFs. Like, for example, our Global Trends kit, which is to kind of mimic global macro. It goes long and shorts, developed market stocks, emerging markets, developed Europe stocks, going long and short through ETFs, by the way. Debt markets in emerging markets as well as in developed global markets. So it's giving you that flavor and that experience there. But it's all part of a global trend strategy.
And how many kits do you guys have in the portfolio to choose from?
Live right now, we're well north of 20.
I
think we're probably always going to manage between 30 to 40, just given on the market timing. Recently, we've launched a bunch of long-short strategies that we thought were much more effective for the current market. So long U.S. markets, short, developed Europe and the world. Long large cap, short small cap, long tech, short the S&P 500, which we just released. Things like that is a way to play the relative outperformance. You guys know about my favorite, which is long gasoline, short oil. That's what I talked about earlier.
How does that trade work? Can you explain that a little bit more?
Sure. We're buying the gas ETF and we're shorting for the same amount. So it's what's called dollar neutral pair trade. We're shorting oil. Is what we're saying is that gas prices over the next few months will relatively outperform oil, so that if prices for oil come down as well as gasoline, the prices for oil will drop faster than they will for gas. Similarly, if they're rising, the prices for gasoline will rise faster than they will for oil.
And that's the way it always works, isn't it?
Right. And as I explained that, you guys are like, yeah, I totally agree with that.
Yeah. Like, I watched oil drop $20 and the gas prices are still the same. They haven't changed yet.
Yeah, it's still paying out the nose at the pump.
Yeah.
Gas prices tend to be stickier on the way down and tend to reprice higher more rapidly.
Are there any other pairs that you like that follow kind of a similar pattern?
Well, obviously, large cap, short small cap makes a ton of sense based on everything we just talked about in the macro environment. Because small caps tend to outperform in a go growth environment. In a slow growth or negative growth environment, large cap will always outperform small cap.
That makes sense too, with interest rates going up, because that's never good for growth.
Absolutely. And then another one that I like, which was the first pair trade I talked about, long U.S. large cap stocks and short developed Europe mega cap stocks. And the thinking here is, look, if we're going into a global recession, the U.S. economy is weakening, the economies of France, Italy, Spain, and Germany will weaken quicker. And we can all agree on that.
I would think, yeah.
How do you express that trade? Here's a trade to do it. You see how simple it is. It's our limited micro theme. You just one tap, boom, put a couple $100 into it, and let's see how it rolls.
Is there any limit to how many different funds you can or investment kits you can invest in?
No, there's no limit to the number you can. Some kits require minimum investment a little bit more than $100, but that's driven by trading minimums that we have to manage.
Oh shit! I think I might be signing up for this as we talk. I'm really liking this whole thesis.
And now at least you know who to email if there's a support ticket issue.
Hey, where did my money go? What do you guys got planned for the future then?
Well, I'm really excited about our hedge kit integration that we're going to be rolling out through a partnership with Plaid in late 3Q, early 4Q. And then 2, I'm really excited about our integrations with some of the broker-dealers where we're going to let folks connect their brokerage accounts, and we're just going to send the trades directly to their brokerage accounts.
Oh.
So let's say you have an account with E-Trade. And by full disclosure, we don't have anything. There's no discussions with the moment with E-Trade, but I love using them as an example because I think they've got a great trading platform. You have a brokerage account with E-Trade and you want to sign up for Q.ai, you just connect your E-Trade account to Q.ai, and then we'll just trade for you.
I like that.
And you're always in control.
Right.
I think it's going to be a great way to really empower customers to really experience a Q.ai investing experience.
I think that's a fantastic idea. That was one of the first people we talked to, Passive, which did just a simple rebalancing. I think that was all that they were really offering. They weren't putting together kits like this. This is more of you pick you basically your own ETF that you want, and then this company would basically tell you when it starts to drift and then execute the trades if you allow it to bring it back into balance.
Sell the ones going up.
Yeah, for us, it's part of this vision of having a custody-less or brokerage-less asset management experience. You get to access elite asset management experiences and solutions through whatever brokerage experience that you want.
Well, I got to say, we're a little bit worried for your health and safety, so make sure you kind of keep in touch with us. So, because if one, you're trying to democratize wealth.
Yeah.
2, you're also using AI, which everyone's terrified of to begin with. But I really like the direction that that it looks like you guys are going, and I love what I'm seeing so far, and I plan on actually trying to open up an account with you guys here in the future.
Yeah, absolutely. And you know who to call and blame if Skynet's released.
Right.
If it's Skynet, at least maybe I'll be on its good side because I'll have invested with him. Nobody thinks about that side of it. Like if Skynet happens, you want to be on the robot side.
Fair enough, touche.
Don't smash your toasters when they go bad. Send them to toaster retirement. Dan, do you have any other questions you want to ask?
Yeah. Would you say that Q.ai is meant for the younger generations, as you mentioned earlier, going to have a lot of wealth transferred to younger generations happening, or because I have some friends that are older in different states of ready to retire or already retired. Is it something like if you say oh, I've already got my retirement in Fidelity, is it something I could just recommend somebody hey, you might want to think about switching over to these Q.ai guys? Yeah,
it's a great question. When we were designing it, we were really focused on the market opportunity, which was mass affluent Gen Z millennials as an undeserved market.
Mm-hmm.
What's interesting is that we've seen a lot of demand from older demographics as well. People have their monies with Fidelity or Vanguard, places like that. They're looking for a more active experience.
Right.
So if you're with Fidelity as an example, it's I'm looking for something a little bit more active. The hedge kit solution I told you about makes a ton of sense.
Mm-hmm.
We all know you're better off hedging. It's where can I get something like that?
So how do you do it? Yeah, that's the part that everyone struggles with.
Yep.
Because it's really hard to throw away money on far dated puts on the SPY.
Absolutely. And you lose a ton of money doing that.
Right. But if you let you let an app do it, then you don't ever see it, and then maybe it's a little less painful because it may still be the right decision. It's just hard to execute it, knowing that what you're buying is protection.
Yeah, one of the speaking of options, one of the major product releases we're going to have coming down the road is going to be managed options trades, where we're going to actually manage options trades for customers through options kits.
Oh, wow.
Yeah, that's going to be a real game changer.
Are you going to do futures at some point too? Maybe a little Forex?
Maybe Forex. I don't know about futures just because of the amount of capital required.
And the insanity of it.
Yeah. From an investing standpoint, I'd love to do it. I just don't know based on who we're targeting, if that makes much sense.
Right. All right. Dan, if we don't have anything else, Stephen, if you'd like to tell everyone one more time where they can find more about you.
Sure. You can learn more about us at tryq.ai. We're both in the Google Play Store as well as the Apple iOS Store.
Also on Forbes' website.
Absolutely. Just QAI Forbes, and you can find out all about us.
And then your socials?
My social for Twitter is at QAI Invest. That's QAI_invest. Mm-hmm. You can also follow me on Twitter at Mathai-Davis. And you can also follow us on Instagram at QAI_invest. We'll
have links for everything in the episode description. So if you don't have a pen and paper while he's reading those out, we'll make it easy for you all to find.
Yes.
Stephen, this has been a fantastic conversation. I'd love to maybe get into more some of the nitty gritty, like how to actually program some of these things, but I don't think that would make for a very good podcast.
Exciting entertainment.
Now that I have your email, maybe I'll just start bombing you with how to write a trading algorithm. Dan, you got anything you want to say before we wrap this up?
No, I don't think I can top that. Stephen, this has been fantastic. I'm very, very glad we got you on the show. And I absolutely recommend QAI after speaking with you and checking out that website. I'm excited. Like Kyle said, I'm excited to put some money in and get started.
I know, right?
Thank you very much for having me on, guys. It's been a lot of fun.
But definitely, when you have some more things happen and some of those things in the future start coming to pass, give us a shout. We'll definitely try to bring you back on so you can kind of update everybody where you're at.
Yeah, absolutely.
In the meantime, if we have nothing else, Dan, you want to take us home?
All right, folks. Thanks for sticking around to the end. We appreciate it. Hope everybody learned some amazing stuff. I know I did. Unfortunately, we do got to close up shop, but we will be back at you soon. Until then, happy trades.
Sometimes you need to take control to make a difference. That's why with FlexPath from Capella University, you're in control. Set your own deadlines and leverage your experience to move at a pace that works for you. Discover a different way forward at capella.edu.
Goodbye.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.